let me have your views on where markets stand right now. I mean, after a 25-30% kind of a year, we're coming to the end of this year. What case can you make out for buying fresh right now versus taking profits in names where you've actually made a lot of profits over the last 12 months?
Right, so for us it's a continuous journey, right? Whether although the year ends,
doesn't make a difference,
sure.
But valuations do.
Yeah, of course. So valuations, in our view, is not that expensive. It's definitely not cheap, but it's not expensive either. Particularly considering that earning growth has come back this quarter. In our calculations, operating profit grew over 15%. We expect that trend to strengthen going forward because of the reasons we discussed why. So our view is that with this kind of earning recovery coming, valuation is reasonable, and the case for fresh buying still exists, particularly in sectors that we mentioned. In terms of taking profits, we would rather avoid stocks where the valuation is expensive and the earning recovery is not there, which would typically be sectors like consumer staples, some consumer staples names, and the healthcare names. So it makes sense to take profit there. Some of the consumer staples particularly done quite well, and add to the sectors where we are bullish earning recoveries, add to those names.
You're not convinced that consumer staples will see decent volume growth going forward, because a couple of these companies seem to show some signs of some rekindling of volume growth in the current quarter, but you're saying the valuations are too expensive?
So consumer staples, so we are quite bullish on the entire, we are looking at a perhaps cyclical pickup of the economy as well, right? So even consumer staples will do well from where they are. But let's put that into context. Let's say they grow their volumes by 7, 8, 9% with some pricing 10, 12%. But because the input price is going up, there's possibility of margin flattening out or even coming off. So they grow the earning 13, 14, 15%. Now for that, would you pay 35, 40 times multiple? We think there are better opportunities. They will also do well. The stocks will also go up. But I think, the sectors that we mentioned, there the stocks will outperform to a greater extent. You'd
be more optimistic or constructive on, say, autos compared to consumer of FMCG?
One would be, but again, auto, we are definitely constructive, but the problem with the auto is, particularly the four-wheelers, there are not enough stocks listed in the market. There are only one or maybe 1.5 stocks listed in the market. So how do you play it? Although we are bullish on the theme, but place to play that in the markets are limited.
I mean, how much of Maruti can you keep on buying, right? What about two-wheelers? You don't think there is any play there now after being out in the cold for so long?
Two-wheelers also, we view them as more or less staple stocks. Again, they will do well because they can come back. Again, we are looking at something like 12-15% volume growth, earning growth there also. And there the valuation is not as demanding. But having said that, at 18-20 times, do we see re-rating possibilities? We don't. And if you look at the other sectors we discussed, there we're looking at strong earning growth and possibilities of re-rating also. So it's just in the pecking order, we would rate even two-wheelers on the lower side.
Let me go back to financials, because I just remembered last time when we spoke, you did speak about financialization of savings as an important theme.
Sure.
That's played out very well. I mean, from brokers, you've had some new insurance companies listing. What are your thoughts on some of the valuations that you find today, starting with insurance, where you have a few stocks to choose from?
Sure. So if you go back to, I think we met in March or April, and till now, that theme has played out, but we do think that life insurance stocks are perhaps there or lower, right? So we remain bullish on that theme, and because insurance stocks went up and they came back down because of supply issues, we remain bullish on that sector, life insurance sector. Turning to brokers, we do think that theme has now played out because those stocks have rallied a lot from there, significantly from there. And although the markets will do well, as many of you would be aware that these brokers also get a lot of, a lot of value from the lending operations. And that lending operations could be under some sort of pressure because they are wholesale funded. So that's one of the reasons why we would now take profit on those broking names. Insurance, life insurance, still bullish.
You think there is a problem with the way bond yields are shooting up back in the country? Do you think that could put pressure on some of these NBFC stocks which have done very well?
That certainly would put pressure on NBFC stocks. And in general, although we think interest rates will remain lower for longer from a longer term perspective, it will rise from the bottom. And that could pressure on the wholesale funded entities. Having said that, the bond yields have shot up a lot, right, beyond 7%. At a time when you're looking at inflation of, even in March, maybe 4.5%, 5%, India has never offered 2% real rate. So in the shorter term, we do think, I have to remember the bond expert, but 7.1% looks too high. So in the very short term, 3-month view, there could be some correction in that yield also.
What about housing finance? Are you still bullish, or do you think now with more capital with the public sector companies, do you think that space runs the risk of too much competition?
So when we look at lenders, we look at either the leading lenders or someone with some niche capability. Housing finance is a segment where you do not require any niche capabilities. Mostly don't. I mean, there are some companies here and there, but mostly don't. And PSU banks having got this recap, and we do think this provides them some bit of growth capital as well. We do think they will have to show growth. And few of the easier areas to lend in a relative sense is housing finance. So this segment will see a lot of competition. And you don't want to be into this competitive business with someone who's wholesale funded. So that's one reason we would stay away from the housing finance, the pure housing finance companies.
What about this whole housing theme per se? Because there's a lot of excitement about this affordable housing. All sorts of companies are doing well. Some are playing it through housing materials like ceramics, tiles, etc. Some through housing finance companies. A, are you optimistic on that theme? And B, what's the best way to play it in your eyes?
We have been bullish on this affordable housing, but I have to admit that this is one theme which on the ground has not played out as much. Because housing volume growth is still going down, right? So, and we are still examining this sector because you see one policy after one another policy coming, right? Very recently we have had even the carpet area going up. So we'll have to wait and see how this plays out. We have to evaluate this part. On the building material sector, again, our thoughts are evolving, to be honest. Because on one hand, you have hopefully good growth of the housing sector coming back. On the other hand, you have the housing market getting consolidated among big builders or a government buying. So when they buy, will the business remain B2C or B2B? We are examining those issues because if you look at all those building material stocks, they're priced as if they're B2C stocks. Their operating profile margin is like a B2C stock. Will they remain that way? That's a question which is in our head. And in fact, this requires, I think, further work even from our side. Today, I cannot give you the answer.
But you think there is a threat that margins will have to come down in this sector as buyers consolidate and they have more power, in a sense, to bargain?
It is certainly a possibility. It's absolutely a possibility. In fact, if there are less number of buyers to go around, why would they give you a higher margin? So, and also many of these companies to sell to a, let's say, single house or a small developers or single house owners, if their mix is going to come down, I would suspect that would take an impact on their margins. You would say,
I mean, this extends to maybe even electricals or those kind of, or plywood or those kind of things?
This applies to building material companies who are dependent on new buildings to drive their volume growth. For example, if you do a fan, light, air conditioner, you need not buy a new house. You can do your own house. Again, you're an individual buyer. That company is B2C. But if that company has too much of product in their mix, which is required when a new house is coming up, that is where we are a bit doubtful.
Okay, fair enough. We haven't spoken about IT so can you take a contrarian call and buy IT stocks now, or the case is not compelling enough yet?
So IT stocks have been lackluster for a very long time. But can we at this stage make a case for further deceleration in IT top line and bottom line margins? We cannot. So IT is one sector where, in terms of fundamentals, the bottoming out process has started. And we do see that there is support from the buyback and dividend and so on and so forth. So while we cannot, at this point, we cannot make a significant upside case for IT, at the same time, we cannot make a significant downside case for IT either.
But it's still a value call, not a growth call.
Correct. Yes, absolutely. Coming to that. Now, when IT is providing a good dividends and cash, and the valuation support, again, for a value-based investor, it should look quite interesting. As far as, let's say, we are concerned, IT is a very large weight in the index. And when they reach some sort of that kind of valuation support, one have to look at it and perhaps think of reducing underweight, not go bullish overweight, but think of reducing underweight to some extent, because IT stocks are truly now looking like reaching a bottom and making a comeback. So to that extent, if you were to compare IT and pharma is perhaps at a much earlier stage of bottoming out. IT is perhaps coming out of it.
Rana, it's been a pleasure talking to you. Thank you very much for your time today.
Thank you.